Hi everyone, I'm Bryn Robinson. The end of the financial year is fast approaching, and here at Fitzpatrick Group we're busy working with our small business clients to minimise their tax liability. But we can't stress enough the importance of putting some time aside to review your business and prepare for the year ahead. There are a number of ways that your tax liability can be minimised, so let's hear from Fitzpatrick Group senior accountants to give you their top tax planning tips for the end of financial year.
Hi, my name's Tyron and my tax tip is asset purchases up to $20,000. If your annual turnover is under $2 million, you can claim an immediate tax deduction for asset purchases up to $20,000. To claim this tax deduction this financial year, you need to have these assets purchased and ready to use by 30 June. If your annual turnover is between $2 and $10 million, you'll be eligible for this tax deduction from 1 July, so hold off making any asset purchases until this date. Note, this is a new budget measure subject to royal assent.
Hi, I'm Chris. My tax tip is superannuation. In terms of superannuation contributions, you can potentially minimise tax in two ways. Firstly, by maximising your deductible contributions as an employer. Now, bear in mind that once super is paid in, it will be effectively locked away until retirement, so you first need to consider your cash flows. Second option is to physically pay the super entitlements on behalf of your employees before year end. Cash flow wise, you'll need to make payment anyway, so it is merely a timing strategy. For both of the above, it is important to know that in order to receive the deduction, the payments need to be received by the appropriate super fund.
Hi, I'm Pauline. My tax tip is prepayment of expenses. A prepayment is basically the payment of an expense in advance. Small businesses can claim a deduction in full for any expenses prepaid, as long as the period paid does not exceed 12 months. The most common types of prepayments are for insurance, interest and rent.
Hi, I'm Peter. Today my tax tip is motor vehicle logbooks. If you intend to claim your motor vehicle as a deduction, then you need to keep a motor vehicle logbook. When claiming for your motor vehicle, you can claim it in two ways, cents per kilometre or percent of business use. If your travel is less than 5,000 kilometres, then cents per kilometre might be best. From 1 July 15, you can only claim 66 cents per kilometre on all cars. If you use your car more extensively, then claiming the percent of business use may be better. To do this, you need to keep your logbook for a continuous 12 weeks, recording all the business trips you do. You also need to keep records of all your expenses for the entire year for fuel, repairs and maintenance, tyres, tolls, and interest on the loans, and if you've bought a new car, also the tax invoice of a big depreciation for the vehicle.
My tax tip is regarding trading stock. The valuation of trading stock in your business affects your profit. An increase in your trading stock value over the year is assessable income, while a decrease in your trading stock value over the year is an allowable deduction. It is important when conducting your stock take that broken and obsolete stock are excluded and only stock that has value is included.
Hi, I'm Chris. One of my tax strategies relates to depreciable assets. Generally speaking, most accountants know of new asset acquisitions because they see an associated transaction appear in the records. However, unless there is a proper sale of an asset, so then there's a transaction, or the client advises the accountant, it will remain unknown what assets have become obsolete, thrown out or stolen. I recommend that where an asset or depreciation schedule exists, you review it to identify any of those assets that can be written off in the year. While still a tax strategy, this process can happen after June 30. The process just needs to happen before your accountant starts work on your year-end accounts.
My tax tip is payment of directors' fees or bonuses. Companies can claim a deduction for any proposed bonuses or directors' fees, even although the payment is not made until the following financial year. The company will need to have a written resolution dated before the 30th of June outlining the proposed payments, and payments will need to be paid before the end of the following financial year. Note that the directors' fees are not deductible if indefinitely accrued and never paid.
How often do you check your debtors balance? Do you have debtors that are older than 90 days? Do you think you won't be able to recoup the amount? Have you tried numerous calls, letters, debt collection companies and even your local solicitor? Have you even attempted to call them personally? If all these have failed, then I would suggest that you look at writing them off and claim a tax deduction for those non-paying clients. Any business that carries trade debtors is basically providing a short-term loan to their customers. This amount can impact the cash flows of the business significantly if your debtors balance remains unchecked. One way to keep this in order is to regularly review your debtors terms and actively chase those that are outside your trading terms.
So you've heard from our accountants with some great tax tips for the year end. My final piece of advice would be to see your accountant to see if any of these tips are applicable to you. If you haven't achieved what you wanted to achieve in the last 12 months, then perhaps one of our coaching programs is suitable for you to kickstart the new year. For more information on tax planning, please contact Fitzpatrick Group at www.fitzpatrickgroup.com.au.